Okay. Thank you once again for joining the IMAP webinar. This webinar has been sponsored by OneVue. The topic is Robo Advice, Disruption, Blockchain Strategies and Other Disruptive Trends. My name is Dan Powell and I'm head of Platform Sales and Relationship Management at OneVue, and I'll be facilitating a session. Let me quickly touch on some protocols for today's webinar so everyone's clear of how it's going to operate. We've placed your phones on mute because we're anticipating over 60 people are registering for this, so there's a little bit of background noise when you have open microphones. So in anticipating that, we have you guys on mute. At the end we can unmute it. People in this room, just be aware that there are microphones on the table. They're very sensitive to paper shuffling and phones vibrating, so just be aware of that. If you have any questions, please enter them in the right-hand corner of the webinar on the chat section, and we will handle those questions at the end of this presentation. Also, at the end of the webinar, you'll be asked to complete an exit survey. There's only 4 questions. We really appreciate your feedback as it provides a guidance for future webinars. And we'll be organising for a soft copy of this presentation to be emailed to you, as well as we'll provide ARK have registered an Australian web address. So if you want to get copies of their white papers, you can register for their white papers, which are very informative, and receive copies of those white papers. Today's agenda is we'll have the guest presenter. I'll introduce Darlene in a minute. Darlene will be speaking for around 35-40 minutes. I'll then have a question time, and then Toby Potter, Chairman of IMAP, will close the session. I might, just before I begin, some people are sort of wondering why OneVue have helped put this presentation together, or sorry, organise today's session. And you may be aware that OneVue is a wholesale provider of platform services and also provides managed account solutions for AFSLs. And we've been working through demand from our white label clients. There's been demand for international securities as a functionality. And so we've been working on that as a solution. We're rolling out in 2 phases. So in about a week's time, we'll have the capability where you can have international SMAs on the menu, and in phase 2, which is going to be launched in April, we'll be offering access to 8 international markets. So advisors will be able to trade on securities in the United States, UK, Netherlands, Germany, Japan, Hong Kong, Singapore and New Zealand. So in planning kind of this messaging around our international capability, we also needed to look for partners to put on that who had their own manage their own portfolios of international securities that could go on the menu. One of the drivers, and a lot of people talk about why Australians need to invest in international securities, but a key attraction, which is probably the most outstanding attraction, is that international markets give you access to industries, to technology and to an R&D that is either not available in Australia, or if it is available, there's a lack of choice. The market depth is limited, and especially with listed companies. The pool of companies in certain market segments is somewhat thin. So we looked at searching for a speaker who could provide us insights into the largest and the most innovative market in the world, being the United States market, and also had knowledge and access to provide investment solutions that we could make available on our platform so that our partners could make available on their platform. And with that, we have been kindly enough to have or accepted as Darlene DeRemer. The background of Darlene is Darlene's US based. She is a well-respected commentator on the influences and trends affecting financial services sector. She is the chairwoman of ARK Investments, and which invests in disruptive technologies. She also co-founded Grail Partners in 2005, and Grail have undertaken over 250 strategic transactions involving asset management businesses. So a bit of an M&A work. Darlene started her career at T. Rowe Price, an organisation that most advisors have heard of in product strategy. Then went to what is now called State Street for a number of years, State Street, and then set up a consulting business. And that consulting business was probably the first consulting organisation in the United States that consulted to mutual funds and managed accounts. And so there's an extensive history there. Interestingly, Darlene also serves on the board of United Capital Wealth Advisors, which is the largest fee-based financial planning company in the United States with over $60 billion under management. So Darlene has knowledge and experience in dealing with the wealth advice side of the industry as well as the product side. So what I'll do is I'll pass on to Darlene to present. Her topic includes Robo Advice, the lessons learned from implementing Robo Advice and who will be the successful players going forward, or should be. Blockchain, what is it? I personally have been to a couple of sessions on blockchain. I still don't get it. So I'm very interested in finding out how it all works, especially recent announcements that the ASX have invested into a US company about blockchain, and they've committed not to invest money in their current technology as part of that strategy. And we'll also look at the impact of other disruptive technologies as well as touching on some product trends on the investment side. So Darlene, welcome to Australia and welcome to IMAP presentation.
Thank you very much, Dan, and thank you all for your time today. It's my pleasure to be here in your warm weather, having come from minus 30 degrees in Boston, Massachusetts. As Dan said, what I'd like to cover with you today is some key trends in the asset management industry globally, and some emphasis on what we're seeing in the U.S. market in particular with ETFs and alternatives, and then talk about a number of the disruptive technologies, and then lastly how ARK's investment solutions are leveraging all of these themes. ARK is one of the first active ETF providers in the United States, which means that it's not a passive product, it's one with 100% transparency, the holdings, and it's one that crosses multiple sectors, so it's a pretty exciting market for us. In looking at the global asset management industry, it's very healthy despite the financial crisis that we all went through. It's over a $300 billion revenue business, and that it's one of the businesses that has the highest pre-tax operating margins of any business, somewhere in the mid-30s. In terms of market growth going forward, however, you'll see that historically the market grew at about 7% per year. During the crisis, it was flat. In the recovery, it was about a 2% growth, and we think the new normal is around 2%, which means that as competitors, it's a game of capturing someone else's market share going forward because it's not going to grow as robustly as it historically has. Looking at the global returns in the markets, you'll see that Australia was one of the best markets last year in terms of a real return, as well as Canada. The US, Japan, and the UK had a very difficult time, and the beginning of this year has been absolutely ugly. In the U.S. marketplace, everything is shifting from maturing baby boomers and the silent generation to the millennials and Generation X. There's $35 trillion of investable assets in the U.S. market that will be in flux as baby boomers mature. They're taking their money out of their defined contribution, your equivalent of your super plans. So there's a huge opportunity to retain those assets in some sort of a guaranteed income solution post-retirement, as well as the whole wealth transfer to the next generation of investors. The next generation, the millennials, the Gen X, are very technologically proficient. They are disillusioned and distrustful of institutions, and they are more of a do-it-yourself investor, hence the reason why Robo Advice is really beginning to take off and get some traction in the U.S. market. There's also a migration to a professional money manager. The do-it-yourself investor has co-opted with a financial intermediary, and it's one where the online channel is one of many channels. We'll call it sort of biopic advice, where you allow people to use the phone, face-to-face, online, and it's all sort of event-driven. The other major theme that we're seeing in the U.S. is the growth in liquid alternatives. Hedge funds, managed futures, downside protected products is really where all the product innovation is taking place. And there's been a huge, as I said, shift to technology. Wealth managers need to embrace this, not be fearful of it, or they're going to be left by the wayside. We have a number of broker-dealer distributor organizations in the U.S. that sort of put their head in the sand and said, oh, this Robo Advice, it's never going to take off. Now, all of a sudden, you're seeing the major wirehouses, the J.P. Morgans, the Morgan Stanleys of the world, the Merrill Lynches, all saying we've got to find a way to participate in this marketplace. The cloud and APIs are going mainstream, and there's a lot of data in the back of the appendix on some of these statistics. And if you look at these new technologies, what it means to financial intermediaries, there's been some recent research that says that 60% of financial intermediaries, financial planners, are citing CRM, customer relationship management systems, and the cloud as being vital to their business going forward. And it's moving completely away from using laptops. And we've seen this migration in the U.S. market, which I know is evidence in your market and others, a migration from sales commission to a fee-based advisory market, one that's based on asset allocation and efficient frontiers. Many of the advisors are going unaffiliated with major banks or broker-dealers and going independent in the U.S. market. And there's this proliferation of advisor groups working with centralized research infrastructure, much like OneVue provides, to give them open architecture, best-of-breed access to external money managers. We're seeing more and more complex products. We're seeing more need for education at point of sale. And certainly in the U.S., coming out of the financial crisis, we're just awash in new regulatory environment, which has really put a damper on the business. The Dodd-Frank initiatives, we're still probably 5 years from fully executing it in the marketplace. So the collaboration with robo-advisors is really evolving in this market. And if you look at the financial advisor today and their customer service models, in the U.S., they're starting to ask for things that they never asked for before. Before, all they cared about was selling a product. Today, it's all about selling a solution in a consultative environment for the consumer. They're asking for their partners to provide upfront and ongoing advice and education on the business. They're looking for business development support. They're looking for risk management. They're looking for thought leadership, technical expertise, business building, and relationship building. So it's a very different model than selling just a mutual fund as we saw maybe a decade ago. And the mutual fund industry itself is large and still growing, although in the U.S. showing signs of maturity. It is a $13 trillion marketplace. It's moving into multi-strategy products, multi-sub-advised, derivatives, bank loans, and other products. We've seen the shift from active to passive. Still 70% of the assets are active, but 30% are passive. But when you look at where the actual flows or sales are going, it's the exact opposite. The active money managers have been in net redemptions for the last 5 years, and all of the net new flows are going to ETFs and index funds. The regulatory pressures I've mentioned, and then the U.S. is a very concentrated market. The top 25 money managers control almost 75% of all of the assets, and that is continuing, although on the fringes there are room for boutique money managers. There's always meritocracy in the marketplace. So as much as the overall assets are concentrated, we believe new startups like ARK can fill a real niche and void in the marketplace. We did see a proliferation of classes of shares in the U.S. marketplace. We were calling it, sort of like alphabet soup. There were so many classes. But as the market is migrated to fee-based, those classes are collapsing, and the intermediary research gatekeepers wants only the cheapest class of shares, meaning there are no distribution fees and no sales commissions. And that's a trend that we're seeing around the globe. In terms of trends, in terms of fund launches, I won't go into a lot of it. I mentioned it was in liquid alternatives. We are seeing sort of multi-strategy and downside protected products. There's been the growth of another new category called ETF strategists, which are advisors who only use ETFs in a fund-to-fund structure for their consumers, and that's a couple $billion marketplace today. These liquid alts are roughly about $300 billion in assets. Many of them did not perform well last year, so we're starting to see some of the product that didn't have integrities beginning to already be liquidated. The ETF market, as I mentioned, is several $1 trillion, continuing to grow, and there's been a number of new developments in the U.S. market. Eaton Vance has created a new patent-protected product called Mix Shares, which is a hybrid between an ETF and a managed mutual fund. So what that means is it's got limited transparency. It's basically got a lag on what the holdings are in the portfolio. And then there are others like ARK who have gone completely active. And we've also seen a decline in expenses of these products. More recently, BlackRock with iShares reduced the fee on a core S&P ETF to only 3 basis points. And sort of the Vanguard effect in the marketplace is even greater, where Vanguard just came out with a product at 1 basis point, which truly shows what a commoditized market some of those products have become. ETF growth remains strongest with sort of non-aligned financial planners, and then what you would refer to as stockbrokers in your marketplace. And as I mentioned, the fees, we really call this the Vanguard effect. It's been dramatic that behind Vanguard, Schwab reduced their fees, BlackRock has reduced their fees, SSGA has reduced their fees. So the ETFs are being used as core with active satellites around the external in the portfolio. If we then look at robo-advisors, many of these robo-advisors are almost exclusively using these ETFs in their asset allocation. Very few are using active mutual fund products because they're trying to deliver a very cost-effective solution to the consumer. And it follows your typical technology adoption curve, if you will. We'd say we're in the early innings here. And that it's got a long way to go. There have been a number of research surveys, including one recently by McKinsey, that suggests that Robo Advice will be $2 trillion of assets under management by 2020. And the market, some of the newer players these are U.S.-centric firms. One is called Future Advisor. That firm was just bought by BGI, BlackRock. Wealthfront is independent, backed by venture capital. Betterment is backed by venture capital, as is Personal Capital. And all 4 of those only use an ETF-only advice solution, all into the consumer. They're paying less than 25 basis points for the entire product. And many of them have no minimums to invest in the product. Schwab has also entered the business. But before I talk about Schwab, what are the customers who's using these products? 30% of affluent investors, and affluent are households with more than 250 of investable assets in the U.S., already use robo-advisors, another 22% that they will within the next 12 months. 65% of the users also have an established relationship with a well-known branded financial institution, so they're co-opting and using multiple advisors today. 52% of the users are Gen X, and another 26% are millennials. So clearly it is trending towards initially attracting younger households, but the investable assets of those younger households are still fairly large. It's been very popular in Silicon Valley in the technology world. If you look at the market share, Schwab is the largest with their launch of their intelligent portfolios about a year ago. Schwab does not charge a fee for the advice product, but they're using their own ETF, so their fees are embedded in their own product. Vanguard's personal advisory service is number 2, followed by Future Advisor, which was just bought for a healthy 13 times forward earnings by BlackRock. And then you'll see there's a number of others. There's probably over 100 robo-advisors in the U.S. market. We do not think they're all going to survive. There's going to be huge consolidation. And many of the larger branded firms are either going to private label, or they're going to acquire, or they're going to build it themselves. So, the robo market, you can see who has the assets and how that some offer only an online solution with no human interaction, where the others like Schwab and Vanguard allow you to pick and choose when you actually co-opt and work with a human financial intermediary. And then we're also saying, lastly, we believe that social media will have a significant impact. We believe Google Finance, Yahoo Finance, Snapchat, any one of these organizations or all of these organizations could become major competitors in providing financial services as a new way to do business with the consumer. And all of it will be done on smart applications. So if we look a little bit at somehow this impacts ARK in the organization where I'm chairing their board, ARK is an investor in disruptive technology. And what is disruptive innovation? Well, you can see over the last 200 years, we've had major significant impacts that changed the world, whether it was the steam engine in 1781, the combustion engine in 1860, television in 1923, microchips in 1971, the internet in 1990. We think currently genomic sequencing, robotics, automation, the cloud, big data, this is the next generation, and that's where ARK is thematically investing, and delighted to be partnering with OneVue to be potentially available here soon. In terms of the internet, ARK has done a lot of research. They have a very unique ecosystem where their research is top-down and bottom-up, and their system involves having outside theme developers, outside subject matter experts who are able to reach and read all of their email, participate in their research sessions, and collaborate on their blog. And they use all of that to garner more information on whether these themes are something that has conviction or one that really is just a fad. And given that view, they think that the internet and computers are going to go by the wayside, semiconductors in particular, and everything is moving to connected devices by 2020. And the amount of data that is going to grow exponentially, at 14 times the amount of data that we analyzed in 2015 going to 2020. Because of that, ARK has one ETF that only invests in the internet. A little bit later in the presentation, I'll give you an example of some of the holdings in that portfolio to leverage this particular theme. Another theme that ARK is investing in, their second theme, is the new industrial revolution. Their research suggests that by 2035, 50% of American jobs will be replaced by automation, which is pretty breathtaking if you think about the significance of robotics and what that means to the business. And we think it's a huge marketplace. We believe it's going to grow at compound annual rate of 30% a year to be a $242 billion market segment in 20 years. It's pretty significant. The third key theme that ARK is investing in is genomic sequencing, leveraging stem cell research, biotech, healthcare, and technology. Today, the human body has over 20,000 genes. Sequencing today is down to less than $1,000, and you can get it in 2 or 3 days. Just a dramatic change in what's going to happen to healthcare and actually preventing disease as opposed to curing disease because of all of this technology that's evolving. We think that this sequencing is going to grow dramatically, compound annual rates of over 200% a year. And because of this, ARK has one portfolio that does nothing but invest in these kinds of companies around the globe. And it's a very concentrated portfolio. And then the Industrial Revolution, I mentioned earlier automation, they clearly see that's taking place. And then 3D printing is a form of automation. This is a newest ETF from ARK. It will be just investing in 3D printing equipment, which is growing exponentially at 50% per year. Most of that is in hardware, but also in software. It's had a dramatic impact already in the medical field in terms of what doctors are able to do. And we think it's got application across numerous different industry sectors. And then lastly, as Dan mentioned, we are very big believers in blockchain technology. And ARK is the only money manager in the US that actually invested in Bitcoin as a public security. And what blockchain really is a disrupted ledger technology. Historically, everything went through clearinghouses, and it was very paper and manual intensive. In this sort of environment, you know everyone who's bought every piece of information, and it's migrating so that it's all automated and everyone can see every individual along that chain. It originated with professors at the MIT Media Lab, and they continue to look at this as a way to disintermediate traditional forms of financial services. Many of the large banks and brokerage firms are all investing in blockchain technology to disintermediate themselves and improve the efficiency of their business. And so, you know, what they've done is they've eliminated the clearinghouse and centralized ledgers, which is what the traditional custody banks have always done in the asset management industry, and each individual is just buying it directly. It's going to have a profound impact on all sorts of businesses: real estate, fixed income securities, stocks, private equity, venture, crowdfunding, securities lending, currency management, IPOs, shipping, logistics, you name it. It's going to be we're going to be able to apply blockchain technology to practically every other industry. And so we're a big believer that this is a phenomenon that will continue. So as I mentioned, ARK has 6 current global thematic funds. The disruptive innovation is their best ideas across the other 5 themes. One is the next generation internet. The other is the genomic revolution, the industrial revolution, and the 2 newest are the 3D printing, and also they are launching an Israeli technology innovation fund, just investing in technology in Israel. If you look at the ARK funds, the Next Gen Fund, some of the largest holdings in that fund are products like LinkedIn, Netflix, Apple, and Red Hat. In the genome, Illuminata, MedData, Monsanto, and Athena Health are largest holdings. In the Industrial Revolution, they own Stratus, and believe it or not, Tesla. And we own Tesla not as a car company, but as an energy company. And we believe that it will have a dramatic impact on batteries. And then we also own Autodesk and some other new automation software. ARK's approach to marketing is really, they've coined a term, they call it high active share, meaning that these funds are not your typical sector funds. And they are uncorrelated to any index. And if you look at correlation relative to MSCI, you'll see that 95+% of the holdings in these portfolios are uncorrelated to the MSCI. So they provide a huge source of diversification in your client portfolios because of that low correlation. And they've got actually a negative correlation to value managers, slightly positive to active managers, but completely away from being a sort of a benchmark hugging product. They are concentrated portfolios, typically 35 to 40 holdings, so they will be more volatile, but they're added as complements in portfolios. The performance of the funds are on this next page. Last year, the 2015, the Internet Fund was up after fees at 15%. The others are sort of in line, sort of slightly down last year in the market. Overall, though, these funds have outperformed their benchmarks since inception, and they've only been in the market since September of 2014. And as I mentioned, they invest in disruptive innovation. And I think maybe, Dan, with that, I'm happy to take questions.
Okay. Okay, we might, thank you, Darlene. So much to absorb, I'm trying to get my hair around it all. So we might ask if there are any questions from the people listening in, if they want to submit via the chat screen on the bottom right-hand corner. But I might also ask some people around this desk if they have any questions.
Look, it's Toby Potter here. So this is a question for both Dan from OneVue and Darlene. So with this type of vehicle, what's the method of accessing this through, for an Australian advisor or investor, and how does it integrate with the international portfolios that you talked about, Dan?
Okay, so where we're doing it 2 steps. So we're launching next week a soft launch. There's one of our partners is got a portfolio of international equities that they're managing as a professional fund manager. So similar to that, the objective is with ARK is in the next few weeks we'll be releasing on the IDPS version. So in our investment side, the ARK ETFs, ARK have I think about 6, is it, or 4 or 6 ETFs, and advisors will be able to buy those ETFs as they buy an SMA. So they're kind of in an SMA structure.
Listed, so an SMA that holds an internationally listed security.
So it's just an SMA. So no different to going and buying, say, a Dalton Nickel Reed or a perpetual SMA through our platform. Instead of buying those, there'll be another line item, buy an ARK ETF, but it'll be in an SMA structure, separately managed account, which is a non-pooled structure under a managed investment scheme, which we, being OneVue, are the responsible entity. And later on, we'll be launching individual equities.
And Darlene, a question then specifically about the ETF market in the US. You mentioned that these are obviously actively managed. I mean, that's sort of goes without saying. How do you see the US ETF market evolving as between the traditional passive index mirroring ETFs and this type of investment?
Well, it's the bulk of the assets today, Toby, are in the traditional passive ETFs. In the last year, there's been a number of new active ETFs launched, primarily in the fixed income sector. PIMCO, DoubleLine, BlackRock have launched fixed income versions of it. ARK is one of the few to have actually launched a 100% transparent active equity product, and behind them now is this new Eaton Vance product called NextShare. And Eaton Vance's product, they will also white label their SEC exemptive release to other money managers. So there's about 30 other US money managers who within the next 12 months will be launching active equity versions of the product. The difference between that NextShare version and the ARK version, the ARK version, every day at the end of the day, you can see exactly the holdings. And the NextShare one, there'll be a 30-day lag on seeing the holdings. And that's really the only distinction between the two. But clearly, money managers in the States are embracing this as probably the next wave of professionally managed money. And it's really putting a lot of pressure on traditional active mutual funds because these products are at a much lower price point.
Any questions?
Money class, is it too early days for these will trade at a premium or a discount to net asset value? What has that fluctuation been to date?
To date, there is some fluctuation if the product is not at scale and you've got severe market volatility where the market makers have to come in and create liquidity. There was a crisis of liquidity, if you will, in August in the US. I don't know how much it got attention here in Australia. But there was some issue with a couple of products that they had a pretty large bid-ask spread, and the market makers came in and corrected that. So the key is you have to be with products that have significant accredited investor APs who want to make a market in those individual securities. The types of securities that ARK invests in, there is a lot of liquidity in those securities, so they haven't experienced more than maybe a basis point one way or another.
Darlene, I've got a question. Taking it slightly differently from being your directorship on one of the advisory boards in the US, from an advisor perspective, what do you see that traditional advisory businesses are doing to, and you talked about collaboration with Robo Advice, but what else are they doing to sort of be competitive when Robo Advice is coming in at such a low cost?
Well, there's a lot of pressure in the US from everyone is aware that the U.S. money market industry is regulated by the Securities and Exchange Commission. However, in the retirement market, which is governed by ERISA, it's the U.S. Department of Labor. The U.S. Department of Labor has put out a rulemaking basically for a new fiduciary standard, which would require that for every retirement account, the intermediary had to do as a fiduciary, what was in the best interest of the investor, which means that all of the products that have been sold historically with commissions are under significant pressure. So things like real estate REITs, limited partnerships, front-end loaded products are all sort of going by the wayside. So many of the intermediaries, like the United Capitals of the world, have moved to a fee-only environment. They've got very extensive investment research infrastructures that they've built up. They're offering new customized, bespoke target date products and other sort of solutions like guaranteed retirement income, all using institutional money managers at the lowest price point possible. They've also stepped up all of that content and knowledge so that the intermediary is more of a providing asset allocation services as opposed to its individual stock picking of securities.
Can I go through again, just see the charging structure to the end client in the States?
Yeah.
In terms of, I think you said you go online and the basis points is X, maybe
Yeah.
just reiterate that,
Yeah.
but you can actually have a choice of online plus advice.
Yes.
So how much actually or how much does the current client pay an advisor so that the advisor can stay in business?
In the managed money business, the equivalent of this trade group, on average today, the fees have come down in the U.S., all in paying for the financial intermediary as well as the money managers underneath the solution. It's probably coming in at about 150 basis points, so 1.5% for the face-to-face advice. For the situation where they want to just do it themselves or do the robo, it's coming in at a much lower price point. So it's almost become event-driven marketing. For example, what we've found is that if an investor has a life event like retiring or changing jobs, it's such a significant decision that they don't want to do it on their own. They want to co-opt it with their professional intermediary. However, if they're setting up, a college savings program and they're just starting out very modestly, they may do that on their own using just an ETF solution. So it's allowing them to pick and choose at what event they want the intermediary's guidance. And so it's sort of almost menu-based pricing today, if that makes sense.
So you've got 150 basis points for robo service plus advice.
Oh, actually, the human advice.
Human advice, whether it's done Robo Plus or
Robo Plus, it could be over the phone or face to face.
Correct. If you go straight to Robo and don't take advice, what will that be?
For some of those providers, they don't charge anything for the advice. It's embedded in the ETFs. And in other cases, it can be up to 25 to 30 basis points. So very different price points.
Thank you.
But there's clear distinctions on the level of services.
We have a question from Paul online. He said, will ARK funds become available through a B2C robo-advisor model offered by OneVue? I guess that will be, we do have two B2C clients. One is Bright Day, the other one being Fat Profits. It's up to them to determine whether they want to go through robo-advice. So at this stage, we don't have a robo-advice B2C partner out there. And at this stage, I think in the Australian market, there's no one out there who is actually executing. There are some advice models, but not at the big end, I would say at this stage, unless you're wrong there. In fact, Darlene, some people would say that robo-advice is a glorified CRM system. Is that a little bit too simplistic?
I think so. because there's a lot involved in it, particularly if one of the key benefits of it is the ability to have aggregation of multiple accounts across multiple custodians. So there's a little bit of work to be done in terms of the aggregation of all of this data. Once all the data is aggregated, and then the advantage of it is it pre-populates so that the amount of work for the individual investor is a lot less once it's originally set up. But up front, there is a bit of work to be done. But it does, you literally can, execute the portfolio on your smartphone today. So there's an awful lot of technology behind it to allow that to occur, and interfaces with brokerage accounts and bank accounts, and it's really become part of sort of the mainstream for a number of consumers.
Are there any other questions?
Can I ask how much have you got in each ARK fund at the moment?
There's about 25 million in each of the first 4 funds. The Israeli fund and the 3D printing have not yet launched. The firm overall has about 500 million under management. The remainder is in separate accounts, including recent wins with some of the larger U.S. public pension funds, where ARK is being viewed as an emerging manager as well as a minority-owned manager. So they're starting to get a lot of traction in the pension marketplace now that they've got a year's worth of track record.
So most of that money that's come in, has that been from selected high net worth individuals or smaller pension companies or internally funded?
No, it's been a combination of, it's been high net worth individuals, family offices, and some institutional money.
The question I had doesn't relate to technology, but it relates to one of the boards you're on, because I'll be interested to see the dynamics in the United States. So you're on the board of this United Capital Wealth, which are fee-based advisors, and they've got 60 billion. What's been their success, and where do they think their success is going to be going forward, grappling with how they leverage technology?
United has historically grown by acquisition. So they have become a home for smaller, independent, unaffiliated financial planners. And what they provide for them is a national brand and a national infrastructure. And much like your platform, Dan, they provide all of the technology tools that would be akin to what an advisor would have if they worked at a major stock brokerage firm like Merrill Lynch or Morgan Stanley. But they provide it at a much lower price point, and they provide it with complete open architecture, so you're not selling any proprietary product. And what they do is they take over all of the middle and back office processing so that the advisor is client-facing with existing clients in new business development, as opposed to doing all the mundane tasks that take them away from being in front of the client. So it's made them more efficient and more productive, and doing it more profitably because of the leverage of scale.
All right, well, look, it's Toby Potter here. I'd like to wrap up this webinar by thanking Darlene for what I found some very insightful commentary on the US market, both just in that last point on United as an advice business, but more particularly, obviously, on the emergence of new and innovative both investment opportunities, but more to the point, the emergence of innovative structures for investment. I think the US market, as we all know, represents, if you like, a free view into the future. Where the US is going today, we are going tomorrow. And I think it's been very interesting to me to listen to how this type of investment in this type of vehicle delivered through a platform like OneVue and appropriate legal structures that work in our market can be utilised by advisors in putting together portfolios that really do enable them to meet their best interest obligations and to deliver to client goals and outcomes. Coincidentally, I was looking a few months ago for some investment vehicles that would actually capture technology. It had seemed to me that as a theme, this was one that as an individual investor you should be thinking hard about because growth is going to come from these types of industries. I've found today's session extremely interesting. So Darlene, thank you very much. The presentation will be available through the IMAP website, and we'll be circulating a link to it. As Dan mentioned, ARK has a number of white papers on related topics, and we'll be circulating links to those to a site which ARK have put up specifically for this audience. So thank you very much. It's been a pleasure.
Thank you all. Thank you.
Thank you.